Yeah, that's right. That's what we're looking at this time with the Chief Executive Officer of Star Advisory Investment Limited, Mr. Kevin Kalufo. He joins us from our Abuja studio. Mr. Kalufo, well, it's Easter, so happy Easter, and thank you so much for choosing to spend some of this time with us.
Thank you, and happy Easter to you as well.
All right, so, I mean, the central bank governor told us this since last year that track was taken from the bankers' night, so it shouldn't come as a surprise. And obviously, the central bank has its eyes on the plan or the target of President Bola Tinubu, which is to service a 1 trillion naira or $1 trillion economy. Do you think banks will follow the way we know what happened the other round, 89 cut down to 25, now we have 25. I wonder how many banks we will end up with.
Thank you very much for that question. I believe that a number of banks would have to adopt some M&A, but most of the tier 1 banks are in a good position. They really just need to add maybe 200 to 250 billion, and seeing how they are conquering the continent for the likes of Access Bank, GT, and many of the others who are expanding across Africa, UBA, I do not see a challenge in them raising the differential, maybe somewhere around 200, 300 billion. They can easily raise that. Nigeria's economy is quite highly liquid right now, and with the new policies by the central bank, which is keeping a lot of gunpowder sterile, a lot of capital sterile within the system, I'm sure a number of people in Nigeria would be willing to, put in money for private placements or share offers by these banks. So clearly, most of them will be able to raise it. I think of the tier 1 banks, only GTB has maybe about 300 billion more to meet up with the 500 billion target for the international banks. For the tier 2 banks who operate nationally, a number of them have maybe over 100 or 150 billion to meet up. I think the most precarious one at the moment might be Fidelity, who just acquired a Union Bank UK. So they are going to be heavily exposed to that difference. So they will be needing maybe somewhere around 300 or more billion to meet up with the 500 billion target for banks who operate internationally. So for me, it's a mixed bag for different banks. So each bank is facing a different kettle of fish. So I believe that there might be some mergers that would happen, especially for some of the tier 2 banks, and maybe some tier 1 banks like GTB might decide to merge with some smaller banks to ramp up, to meet up the. But let's not also forget they have a 2-year window to meet this target. So I think most of the mergers will not happen in the first year. They will most likely happen maybe when it's closer to the deadline. Most of them will happen maybe in the second year. That will be 2026, between 2025 and 2026. So I think it's they've given them enough time to meet the target, and Nigeria desperately needs stronger banks, stronger financial institutions, stronger insurance companies for them to provide the credit to grow the real sector. Considering the fact that, credit to GDP ratio, Nigeria is just about 14%, compared with the big economies who are doing over 100% credit to GDP ratio. We do need massive influx of this funding. So I think the next thing for the CBN to do would be somewhere down the line when they start easing this policy of CRR at 45%, they might do well to connect this and make it that whatever money they are releasing for banks to now use in doing business should be strictly targeted at the real sector. Yeah. They should prevent them from putting those money into treasury bills.
So that's what I wanted to ask. That, it does not automatically mean that stronger banks will make more funds available to the real sector, because of course you do have the interest rates to consider, and you do have issues like inflation and the purchasing power of the real sector and all of that. So we might have stronger banks or more funded banks, but I don't think that automatically translates to more funding to the real sector.
Yeah, you're very correct. It doesn't automatically translate to more funding to the real sector. Seeing what has happened since the new policies around FX, you can clearly see that with the sterilization of the funds within the financial sector, there's been less pressure on the naira because there's been less trading in the dollars. So you can clearly see that some people make more money. A lot of the financial institutions make money from investing in treasury bills, government bonds, than doing the real mediation, which is lending to the real sector to create wealth, you know. So there's that issue that banks seem to be more comfortable funding treasury bills, giving government money, what they consider zero risk, and trading in FX and things like that, you know. So for the economy, for it to translate to what the government wants, they need to be able to curtail that to prevent the liquidity. Once they ease the CRR and the liquidity ratio, they need to be able to curtail what they use the monies that they will be releasing for them to trade with into funding the real sector, because that's the only way we will be able to have that growth in the economy that we desire.
So another aspect is obviously because the central bank has noted that it is new funding that they need. It's not existing one. So I guess the capital market is going to get really, really busy before the end of that deadline, which is in 2 years.
Yeah, the capital market will get busy. Though I would also say that a lot of the new funding would not necessarily all come from within Nigeria. As you can currently see, with the new policies, the FPIs have suddenly found Nigeria their new beautiful bride. So there's a lot of money coming in from outside the country. So we would find also foreign investors keen into this opportunity to invest in Nigerian banks, especially for the banks that are, you know, efficient, who are profitable, especially for the banks who are also expanding across the continent, like the likes of Access Bank, UBA, and all that. You know, they would be very attractive to foreign investors as well. So it's going to be rosy for those big banks, but for some of the tier 2 banks, they would have to dig in deep. They would have to hit the market early. They might even have to adopt multiple options of both private placement, the offer to the market, and many other options. They might even have to, at the end of the day, still do some merger and acquisition, because clearly some banks will struggle, a few banks will struggle to meet this requirement.
As you noted, I think
the time frame.
We are expecting some mergers and acquisitions, yes.
Yes, definitely. A lot of the tier 2 banks would be there will be targets for acquisition by the stronger banks. It's also an opportunity for entry for maybe some international players, international banks who are seeking to acquire local banks. This might be an opportunity for them to come in, acquire some local tier 2 bank, and maybe even increase their capital and take them forward, and eventually they become tier 1 bank. So a lot is going to happen in this next 2 years in the banking sector. The only desire for everyone is that this would translate to increased credit to the economy. 14% to GDP, credit to GDP ratio is abysmal. You know, we should find a way to increase it to at least 50 to 70%, and from then on to meet up with the big countries who are doing over 100% credit to GDP ratio. Nigeria is poorly funded. Nigerian private sector is very poorly funded. Barely 5% of Nigerian companies have ever accessed any form of credit from the banking sector.
So just briefly now, Mr. Kulafo, what's the fate of investors in some of this, especially the tier 2 banks, you know, that may get, acquired or merged and all of that. What happens in such scenarios?
So it depends on who is acquiring. If it's a strong player that's coming to acquire, they might have a better deal. If it's a big tier one bank that's acquiring them, they might have a better deal in terms of economies of scale, in terms of profitability for them on the medium to long term. But if it's a private equity firm who is coming to invest, they are not coming to invest just for the sake of growing the business long term. Most times they will come in, they have an exit period they have in mind. So if you have a core investor coming to invest who has an exit period of maybe 5 to 7 years, there will be a lot of things that will happen. There will be a lot of cost cutting, and investors might not get the best deal because whatever pays the core investor is what will happen, not necessarily what happens to the retail investors who own, little shares in those banks. So it's very important that the boards of such banks prepare a strategy in how they want to meet up with this requirement that would enable them retain value for existing shareholders.
And they do have, I think, till is it middle of next month to submit their plan, how they're going to, and I guess this should also be made known to investors because a lot of reassessments of portfolios, I think, will happen on the stock market.
Yes, clearly a number of banks would be considered risky in terms of investment. Some investors might dump some bank shares. Banks that are considered unlikely to be able to meet the new requirements would have their share prices depreciated because there will be dumping of such shares. But coming from the standpoint of an investor, you'd also want to consider that if you have a very good idea of what the bank strategy is in meeting these capital requirements, it might actually be a good time to invest, as a new retail or core investor at this point before they go into the full capital raising mode. It might be a good time to come in when it's cheap. So when the prices are depressed, some investors would take position, and expectedly somewhere down the line when the strategies are made public and when maybe you have some private placements happening, and they can now clearly see that they are clearly on the road to meeting that requirement, that the prices will appreciate on the stock market, So it's still wait and see for me, but for some banks, it's a no-brainer. They are going to meet the requirements very easily. But there are some banks that might be slightly challenged.
All right, well, coming days will reveal a whole lot, both for investors, the banks themselves, and the regulator. But thank you so much for your time, Chief Executive Officer of Star Advisory Investment Limited, Mr. Kevin Nicola, for joining us today.
Thank you for having me.